Hi everybody, we're back. Okay, so the next budget that we're going to do for this chapter is the cash budget. And what we're doing here is we're doing a cash budget for the month of May, June, and July. And understand that these are estimates, okay? Not everything's going to happen exactly how the company wants. So we have some information, we have some sales for May, June, and July, we have some manufacturing costs, we have some selling administrative, some capital expenditures, merchandise for cash. They're expecting to sell 10% of their sales for cash. 90% of that is going to be on account. For the sales on account, we're planning to collect 70% the month following the sale and the balance after that. The manufacturing costs have $3,500 worth of manufacturing costs have $3,500 in it that has depreciation, insurance, property taxes, and expenses. So when we're figuring out the manufacturing cost, we're going to have to take that out. Manufacturing, we're going to pay 80% in the month in which it incurred, and then the balance is going to be on 20% the following month. Our cash balance beginning May 1st at $33,000. We have marketable securities of $40,000. Here's our accounts receivable for March and April, our sales on account for March and April, what our current liabilities is, and we estimate in June to have income tax payment of $14,000. We have dividends that we're going to pay in July of $5,000, and we want to maintain a minimum cash balance of $30,000. So what we can do is we can put together with all this information a cash budget together. So let's first look at cash sales. Now on cash sales, we determined that hopefully 10% of our sales are going to be cash. So we can take our $86,000 for May and we can take it times 10%. We can take our $90,000 times 10%. We can take our $95,000 times the 10%. Okay, then we need to come down. I've created a little collection on accounts receivable. So why do we need to know about March sales? Well, we have the month following the sales on accounts, we get 70%, and the balance of that we get 30%. So we need to know that we have sales on account. March is 60% or 60,000, and April is 72,000. So in May, out of that 60,000, we have a balance of 30% that we're planning to collect, and that was the open balance of it. For April, so April, the month following, so we can take the 72,000 and we're going to take 70%. That's what we're going to collect in May. In June, that 72,000, we're going to collect the balance of 21,600. So May sales, we're not going to collect for May. We're not going to collect any May sales. But in June, for the May sales, the 86,000, 90% of that is on account, and we're going to collect 70% month following the sale. So we're going to collect $54,180. So in July, we're going to, sorry, my mouth is dry. So for July, we'll do the 86,000 times the 90% times the balance of 23,220. Okay, so in July, we're going to collect some of June's. We're going to do the 90,000 the 90%, and we're going to be collecting 70% of that. Okay, so that gives us right there, that gives us the amount that we're going to collect from our accounts receivable. We can bring that over here, $68,400, $75,780, and $79,920. Add those together. So now we have total cash receipts, $70,000, $84,780, $89,420. And understand again that this is an estimate. We may not collect a full 30%. We may only do 20%. But as a budget, we want to get an idea of what we need to collect. Okay, so then let's do the manufacturing cost. So payment of accounts payable. We had current liabilities in May, so we're going to collect that $6,000. We're going to pay that $6,000. So then in July, or I'm sorry, how about we do June? Okay, we have $34,000. We have that $34,000. We need to take off that depreciation, insurance, and property tax because that was included in the manufacturing cost. And we need to times that. We're going to pay the balance. Remember, we're doing June's payments. So we paid 80% in May, so we're going to pay 20% in June. So July, we're looking at the balance that we're paying there. So we look at the $39,000 of manufacturing minus the $3,500, also times the 20%. Okay, so that's the payments of accounts payable beginning of the month balance. Now payments of current months. That's going to be the 80% of it. Okay, so we do the $34,000 minus the $3,500 times the 80%. Now we do the $39,000 manufacturing minus the $3,500 times again 80% because we're paying that in the month that it was incurred. So here we have $44,000 minus the $35,000 because that was part of the manufacturing cost times the 80%. That gives us up here our manufacturing cost of $30,400, $34,500, and $39,500. Okay, they're giving us over here our selling administrative expenses on these three. So those can just be brought over, $15,000, $16,000, $22,000. They're showing that we're going to have a capital expenditure. So we're actually maybe purchasing some equipment. That's going to be $80,000. Other purposes. So income tax. So they told us that we're going to have an estimated income tax payment in June of $14,000. We're also going to pay in July dividends of $5,000. Okay, so I can add all of our cash payments. So then this gives us the difference between our cash receipts and our cash payments of $31,600. I'm going to copy that across. Okay, right now it looks bad. Beginning cash balance. So they told us cash May 1st was $33,000. So we can add our $31,600 plus our $33,000. That gives us $64,600. Your ending balance in May for cash is your beginning balance for June. Okay. Let me go ahead and add that across. So now your ending for June is your beginning for July. then we can total that amount. They told us on here a minimum cash balance of $30,000. So we have 30,000. Oops, let's do another zero there. 30,000 that we need to maintain. Okay, so then the difference between those is our excess or deficiency. Yes, you see that in July, this is correct. We have a deficiency of $2,200. The main reason on this one is we have a capital expenditure of $80,000. Okay, maybe the company needs to look at that. Now we have $54,800 in excess, so it's just something that they will have to look at. Maybe they need to look at paying that capital expenditure, part of it in July, and then the balance in August. What they would need to do is they would have to do another cash budget just to see how August, September, and October are looking at. So that's kind of what you have to do with the cash budget. You need to break all the information down. I think on your problem that you're going to be doing, you're going to get a paragraph of information. They're probably going to tell you some of this, but then you have to pick out what pieces are relevant to being able to prepare your cash budget. Any questions, just feel free to let me know. Thanks.